modern capitalist economy operates primarily on the basis of wage labor, which means that workers depend on money as opposed to property for their livelihood. To ensure security in old age, workers and their employers must contribute money to some sort of retirement or pension fund, the same way that squirrels gather nuts before the winter. Saving money is hard, and the difficulty is compounded by inflation. In order to really get ahead of inflation, retirement money must be invested in the stock market. Most retirement plans offer workers a variety of stock funds to choose from. Investing savings in this way might seem like the responsible thing to do, but this practice is facilitating an unsustainable financial system. Investors look to the stock market for growth, and much of this growth comes from speculation. The price of a stock is really a function of that company's expected dividends, the future profits that the company is expected to generate. In theory, a stock is worth owning even if the stock price does not change. If it produces regular dividends, there's no need to sell. But investors today do not buy and hold stock in order to collect dividends. They buy hoping that the stock price itself will increase. It's about buying low and selling high. A good speculator looks for ways to maximize price changes and minimize the time between trades. Wall Street has mastered this strategy. The trading has gotten so fast that it has to be done by computers. It's easy to put all the blame on Wall Street, but the speculative spirit is found throughout all of society. We find it among home buyers who hope that the value of their home will increase over time. We see it among entrepreneurs and venture capitalists who build startups and then look for a quick exit. It is found among corporate executives who apply short-term strategies so they can take advantage of their stock options. And everyone who puts money into retirement plans relies on the assumption that the stock market always goes up over the long run. But is this a reasonable expectation? It is speculation, pure and simple. Speculation adds no real value to the economy, but extracts value from it. It violates the fundamental principle that we should derive value from the long-term use of capital rather than the exchange of capital. Another problem with traditional retirement funds is that they place a large distance between shareholders and the companies they own. Many people saving for retirement do not know what specific companies they have invested in. They collect the financial benefits of ownership, but do not accept responsibility. Those shareholders who actually want to influence corporate policy may have a hard time doing so. This distance violates the fundamental principle that owners of capital should manage that capital actively and directly. Because of absentee ownership and the lack of worker ownership, corporations are not focused on what's best for employees, society, and the environment. They are focused only on profit and share price. This causes managers to make poor decisions. Clayton Christensen pointed out, for example, that the desire to maximize return on assets has led many American companies to outsource large portions of their value chain to Asia. This action places even greater distance between the tools that support life and the people who benefit from such tools. As a result, the capital that America once had is gone. Jobs have been offshored, and the US has lost its competitiveness in manufacturing. The problems of speculation and investor detachment are the result of the commonly held belief that you should let your money work for you. We trust in the ability of money to command the labor of others, but it's not right to passively live off other people's hard work. The primary purpose of a business is to meet the long-term needs of workers, not outside shareholders. Control of the business and the distribution of profits should be prioritized accordingly. So when a business is trying to raise money, the first source of capital should come from workers purchasing their ownership stake. If additional money is needed, then the company can explore debt financing through credit unions, and equity can be offered to others who have a direct connection to the business, such as partners, suppliers, customers, and members of the local community. As investors, we need to realize that true security comes not from accumulating money, but from owning productive capital. That means our first priority should be to work in a cooperative enterprise and purchase ownership in that business. For the purposes of diversification, we should also invest in other worker-owned businesses that we have a direct connection to. We should make the effort to exercise our responsibilities as investors and be aware of what's going on at the companies we own. Our investment strategy should be to buy and hold, collecting dividends over time rather than turning the shares around for a quick profit. To balance out the risk in our portfolio, the money that is not invested should be saved in credit unions. This approach to investing and business financing offers multiple benefits. For starters, it puts an end to the speculative financial world, preventing it from extracting wealth from the real world. Also, it is sustainable. When workers and investors take responsibility for the businesses they own and derive value over the long term, they will take actions that benefit the environment. And finally, it brings people together in a way that is similar to what credit unions call a bond of association. When people in a community work together, they help each other and they hold each other accountable. Direct management of capital encourages localism and subsidiarity, and it helps to establish an economic republic. Shifting our money in this way will not be easy. The changes we need to make in order to fix our economy are significant. In our next episode, we'll look at ways to overcome these obstacles and discuss some of the possible tools that can help us as we move from theory into practice.